So we've had a lot of volatility as of late. So one of the indicators we look at heavily, we've talked about in the past, but we're going to do a little bit of a deep dive into it, is the market breadth. And we're kind of seeing some bad breadth as of late. So we're going to dive into the details. My name is Brian Cannon, and welcome to Markets in 5. So as always, before we dive into the details, let's get a quick market update. So we've had a lot of volatility as of late, but the good news is that even though we breached the major support line that we wanted to see held, it did pop back through it as of Tuesday. So we breached it on Monday and popped back through it positively on Tuesday. Now, what's important is that we had a major level of resistance or really support at this point. So in the pink arrows, we had hit it as resistance, hit a resistance, popped through it, came down, and then held it as support. So if that continues to hold, that's a very positive sign. And then in addition to that, we also have the 50-day moving average was held here in the red line. And then also, of course, our blue line, even though it was breached, it came back through and popped up to the upside. So when we talk about market breadth, we're talking about the number of companies that are participating in the growth of the index. So in this particular situation, we've got the S&P 500. So you see that it's basically at all-time highs. It's held the support line that we talked about, came down, kissed it yesterday, popped back up. So again, we're watching that real closely to see if we can hold it. But what's interesting is that the underlying current to the market is not so favorable, right? So when you have less and less companies participating in the growth of the index, that can hold up only so long before the whole thing kind of starts to pull down. So we saw this negative divergence back in the beginning of 2020, actually before the pull down. So you had the S&P reaching all-time highs, but you had less and less companies participating in it. And of course that preceded the big pull down in 2000, so or 2020, sorry. So you're starting to see the same type of negative divergence that are occurring. Again, they can occur over a kind of a long period of time, but the bottom line is it's something to keep our eye on, and we really want to see this line being held over time. So if we pop down and we break through all those levels of support, it's time to go into protection mode. So when we do technical analysis, the main reason is so that we can protect on the downside. Of course, there's no guarantees. There's no guarantees in life. But we're going to do our best to make sure that we're not giving back your hard-earned money. So, for instance, you can see this technical level of support was taken out, and the market gave back from peak to trough over 20%. Here it was over 8%. Here in the pandemic last year, almost 36%, and then followed up by almost 11%. And so again, we're watching this level very closely. So what we want to avoid is those life-altering pull downs that, when you reach retirement and you're on a fixed budget, you just don't want to have to give 30% of your budget up just because the market took it back. So when we look at the NASDAQ, you can see that, of course, we've had this breakout we've talked about over the last couple of weeks or so. It broke down on Monday and took out the 20-day moving average. However, on Tuesday, pulled back through. So that's a fairly positive sign. So if it can hang on to that momentum and continue to pull it up, that's a good sign. The one caveat to the good sign is the fact that, like the S&P 500, underneath the surface, the picture isn't as rosy, right? So we've got some bad market breadth here, right? And so you've got, again, the NASDAQ reaching all-time highs. Of course, it came down, held that support, and is pulled up a little bit. But again, you're having less and less companies participate in it, and that can be a troublesome sign as we move forward. So it's going to be so important that we watch these levels of support, and if they get taken out, there's just no reason to take that level of risk and accept it. It'd be so much better just to be in cash at that point. As you can see, market breadth is an indicator that we use that potentially could give you some good insight as to kind of what might come. Again, no guarantees, but at the end of the day, if the market has bad breath, you might want to be a little careful. So thanks for sticking with me, and we'll see you on the next Markets in 5.